Okay, hello class. Welcome to Introduction again to Financial Management. Now we'll talk about financial statements, cash flow, and taxes. So what is an annual report? So an annual report is a report issued annually by corporation to stockholders. It contains basic financial statements as well as management analysis of the firm's past operations and future prospects. So this is usually composed of a balance sheet, an income statement, a statement of cash flows, and statement of stockholders' equity. So it would usually contain two types of information. First, there is a verbal section, often presented as a letter from the chairperson, which describes the firm's operating results during the past year and discusses new developments that will affect future operations. And secondly, the report will provide the four basic financial statements, which I have mentioned earlier. So first, let's discuss the balance sheet. So this is a statement of a firm's financial position at a specific point in time. So this is actually a snapshot of a firm's position at a time. So a typical balance sheet would look like this. The left side of the statement would show that the assets the company owns, while the right side would show the liabilities and stockholders' equity against the firm's assets. So it would show the composition of how much of the assets were taken through loans or liabilities and how much were taken out of capital. So that's the major categories for assets. It's current assets and long-term assets. Major categories on the right side would be current liabilities, long-term debt, and stockholders' equity. So please take note that stockholders' equity is usually paid in capital plus retained earnings. What we meant by retained earnings is the accumulated income over the years, and they paid in capital of how much their actual payment for the capital or for the stocks for that matter. Okay, so let's go into an example. So this is an example. This is years ago. This is 2008 versus 2007. Please take note that this is in millions of dollars. So this is an example of a balance sheet. So when you look at the balance sheet, you look over several items aside from what is presented in front of you right now. So additional points would be, first is the cash versus other assets. Okay, so I'll just use my pointer. Okay, let's use a pen. Okay, so this is the cash. So cash, okay, sorry, my pen is not working. Why is it not working? Cash versus other assets. So although assets are reported in terms of peso amounts, in this case dollar amounts, only the cash and cash equivalent accounts represent the actual spendable money. So in this case for 2008, that's $10. For 2007, that's $80 million. Okay, this is in terms of millions. So for this matter, okay, and the cash they would bring in if they were sold today could be higher or lower than the values reported in the balance sheet. Second one is the working capital. So current assets, so this one, okay, this one, current assets, are often called working capital because these assets turn over, that is, they are used and then replaced throughout the year. So these are usually fast moving. Okay, net working capital, so when this specific company buys inventory on credit, its suppliers in effect lend it the money used to finance the inventory items. So they could have borrowed from the bank or sold stock to obtain money. So these loans are showed as accounts payable. So this one, accounts payable and typically are free in the sense that they do not bear interest. Similarly, if it would pay its workers every 2 weeks and pay its taxes quarterly, so the labor force and tax authorities provide it with loans equal to its accrued taxes and wages. So if we subtract the sum of payables plus accruals from current assets, the difference is called net working capital. So just place it right here. So net working capital is equal to current assets less payables plus accruals. Okay, please take note of this one. Fourth one would be the other sources of funds. So most companies finance their assets with combination of current liabilities, long-term debt, and common equity. So some companies also use hybrid securities such as preferred stocks and convertible bonds. Another thing to look for is the depreciation. So most companies prepare two sets of financial statements. One is based on what is required by the Bureau of Internal Revenue, and the second would be based on the generally accepted accounting principles. Please note that most of the time depreciation is not acceptable is not allowable as a tax deduction under the rules of the Bureau of Internal Revenue, which you would know much better or in depth in your taxation. Okay. Sixth one would be the market values versus book values. So companies generally use GAAP to determine the values reported on their balance sheets. In most cases, these accounting numbers are different from what the assets would sell for if they were up for sale. Okay, so that's book value versus market value. So under GAAP, the company must report the value of this asset at its historical cost less accumulated depreciation. Okay, so, and the seventh one would be the time dimension. The balance sheet is a snapshot again of the firm's financial position at the time. So for this one, in 2007, you can see the total assets is at 1,680,000, while in 2008, that's at 2 million. Okay, so that's the difference. So we can see how it grew from 2007 to 2008. So what is an income statement? So it's a report summarizing a firm's revenue, expenses, and profits during a reporting period, generally a quarter or a year. So net sales are usually shown at the top statement. What usually is commonly deducted or okay, so where was I? So for this one, so the net sales are shown at the top of the statement, and operating cost, interest is subtract. So what is important for this actually? Aside from looking at the earnings per share, analysts usually check the operating income, which is derived from the firm's core business. So this is usually sales revenue less operating cost. So that is what we call EBIT. So that's very useful in the real world scenario. So I need to take a better close look at that. So this is an example. So from 2008 versus 2007. That's the figure. So for this one, as you can see here, okay. So let's use the pen. So the earnings per share is computed by net income over common shares outstanding, and the dividends per share is dividends paid to common stockholders less over common shares outstanding. So different firms have different amounts of debt, tax carrybacks and carry forwards, and things like that to be taken care of. So for this one, what you need to check is the depreciation, the amortization, because depreciation and amortization are usually non-cash. Okay, these are usually non-cash expenses and usually are not deductible for tax computation purposes. So most of the time, um, what what analysts would check is the EBITDA. So this is the EBIT. So what's EBITDA? So EBITDA is the earnings before interest, taxes, depreciation, and amortization. So you, in simple terms, that's net income, and then you add back the interest, the taxes, the depreciation, and the amortization. Okay, so while the balance sheet represents a snapshot in time, the income statement reports over a period of time. So this is for a specific period only. So for this one, this is for net income for 2008 only, and this one for 2007 only. Okay, so let's proceed. Okay, so what is statement of cash flows? So for statement of cash flows, that is a report that shows how things affect the balance sheet, and income statement affect firms' cash flows. So there are several things that are to be taken into account. So this is an example. So for the operating activities, this section usually deals with items that occur as part of the normal ongoing operations. So it is composed of operating activities, net income, depreciation and amortization, increases in inventories, accounts payable, receivable, wages, and things like that. So most of the time this is related to current assets and liabilities. So you just place it here. So for the long-term investing activities, it refers to all activities involving long-term assets that are covered. For financing activities, that refers to notes payable, bonds outstanding, and dividends to stockholders. By now you should get the idea of what statement of cash flows is. This had been introduced before, so I hope that you know how to prepare this one and you know how to analyze. Okay, there's one. So for this one, would this be a concern to you or not? So in this case, it should be of concern because the company was able to cover the small operating deficit and the large investment in fixed assets by borrowing and reducing its beginning balances of cash balances. However, that cannot continue indefinitely. In the long run, as you can see, it would need to borrow, it would need to show positive operating cash flows. So the operating cash flows at this case is negative. So actually this is concerning because ideally operating activities should be positive. Okay, so question: if a company has high cash flow from operation, does this mean that cash as shown in the balance sheet will also be high? Actually, not necessarily, because the company may have invested heavily in working capital and or fixed assets, and it may have borrowed a great deal, or it may not have had much initial cash. So there are other things to consider aside from looking into statement of cash flows. Okay, so we'll go on to the statement of stockholders' equity. So this is a statement that shows by how much a firm's equity changed during the year and why this change occurred. So that is not that difficult to explain. So let's move on. So What is free cash flow? So that's the amount of cash that could be withdrawn from a firm without harming its ability to operate and to produce future cash flows. So you compute free cash flow by multiplying your EBIT, earnings before income taxes, by 1 minus T. So this one refers to the tax rate. T refers to the tax rate, plus depreciation less capital expenditure plus increase in net working capital. So the increase in net working capital is computed by change in current assets less change in payables and accruals. Okay, so as far as we have focused on the financial statements, it is important that the concept of free cash flow be introduced. Okay, it is important to large companies free cash flows. It's because security analysts use this to help estimate the value of the stock. Okay, so the EBIT is multiplied by 1 minus tax rate is the after-tax operating income that would exist if the firm had no debt and therefore no interest payments. And depreciation is added back because it is a non-cash expense. And capital expenditures are those investments are necessary to sustain the ongoing operations. So if the FCF or free cash flow is negative, that would mean that things may not be as bad. You should know what is the main reason why it went negative. So most rapidly growing companies would have negative free cash flows. The fixed assets and the working capital are needed to support rapid growth generally exceed cash flows from existing operations. This is not bad, provided the new investments are eventually profitable and contribute to the FCF. So most analysts regard FCF as being the single most important number that can be developed from accounting statements, even more important than net income. Okay, so you need to understand this one. Okay, so read more about free cash flow and how to compute this one, and also read on to some taxation related questions, because there are things that have evolved in taxation. That is why I will not discuss further on taxation, because you have a separate subject for that one. So I need you to check on the basic taxes, corporate taxes. Okay, so I'll be giving several questions for this. You research more on free cash flow. You try to research on different financial statements and check on how you'll be able to analyze that, because by now at this point you should be able to analyze and give interpretations already of the balance sheet and income statement. So in the next part, in the next video that we will be having, we will focus on the analysis of the financial statements, the ratios and such, and I will give that as an assignment to everyone. So please be prepared already of the different types of ratios that are used to analyze the trends and such in the financial statements. Okay, so I guess that's it, and more or less I'll be giving you what's this? I'll be giving you a short quiz on the next meeting, probably a 10-minute short quiz. So that's going to open from 2 p.m. until 2:10 p.m. only, and I'll close the quiz bin as soon as the 10 minutes has stopped. So I think that's it. So if you have questions, please send me a query or as a comment in this video lecture video. Okay, so thank you guys.